Yeah, this 20% import tax might lead to a 20-25% appreciation of the dollar, and this is definitely the highest risk that we see in the currency market.
So Francois, when analysing the current macro situation, what is the current trend that we're seeing with the US dollar?
Well, the current trend is like the quotation that you hear in the trading rooms. Remember that the trend is your friend, and there is clearly a positive consensus for a stronger dollar. This consensus took place in July 2016 with this reflation theme, and found a second wind following the unexpected election of Trump in the US. I think today we are quite in a good environment for a stronger dollar. The Federal Reserve will definitely hike interest rates, and they started to hike interest rates, which is probably a bit different than the situation that we experienced a year ago. If you remember, in January 2016, the dollar have seen quite a strong correction as people were expecting the Fed to raise interest rates. And we had at the same time the Chinese slowdown, and people were a bit nervous about the indebtedness in US dollar for these emerging currencies. Today I think the situation is a bit different. We are talking about an easier fiscal policy, which is probably a good sign, a good support for the US real rates and for the dollar, like what we've seen in the early 80s. People are really looking for yield, and the Fed is definitely hiking the rates, even despite the fact that we are in quite a low rate environment. I'm convinced that chasing the yield is making some other markets nervous. We've seen China that was a bit nervous and trying to prevent capital outflows. And the support for the dollar shall remain due to these good fundamentals. We have quite a good consumer sentiment, and we have a positive sentiment globally that shall lead to a continuous strengthening of the US dollar.
And amid the United States election uncertainty, all eyes were on the US dollar, and they are continuing to be so. So people are questioning if this trend is going to remain, and some people are quite cautious around the dollar. You're expecting this trend to remain?
I think it's right. On the short-term basis, we might experience a bit of correction on the US dollar. We've seen that the spread between short interest rates in Europe and in the US is narrowing. Some investors are a bit nervous also to see how the new elected US president will implement his measures. These fiscal policies is a threat. The border adjustments also is a threat. Here I think we might experience some volatility, and that's what makes investors a bit nervous about the dollar. Probably the trend will remain positive on the medium to long term. On the short term, these uncertainties and the measures that have to be taken by Trump, and these narrowing spreads on the short-term interest rates might be a threat for the US dollar. What we are playing, and the reason why we remain positive for this dollar, is that we think that the 100 days of Trump taking power in the US will probably shake the mechanism and bring some support for the reflation trade, as I mentioned before, and for the Fed to have the ability to raise interest rates. We have a little bit of inflation. Wages are on a good path, and that will probably be also some ground to the Fed to normalize interest rates. We are talking nowadays about these border adjustments, which might bring some volatility on the US dollar. Yeah, this 20% import tax might lead to a 20-25% appreciation of the dollar, and this is definitely the highest risk that we see in the currency market, is a sharp rise of the US dollar. We hope that the dollar will appreciate gradually, because a sharp rise of the dollar will be detrimental for US companies, in terms of revenues and earnings, especially those who are making revenues outside of the US.
And you've mentioned some of the risks there, but this is also a fantastic opportunity for investors to maximize profit in their portfolio. So how would you advise investors to maximize these profits and their portfolios at the moment?
For the time being, there are several ways to be invested and benefit from the dollar. Talking about the non-dollar denominated accounts, it's quite easy to play. We are invested in gold. Gold is an asset-based dollar that is also a hedge against inflation. And we are buying dollar-denominated assets that are helping the performance over the past 6 months. For the dollar-denominated accounts, it's a bit more complicated. So here we have to play several trades, FX trades. For those who want to be invested in G10 currencies, we recommend to be short euro, long dollar at the current level. And we think that we might see levels below the parity for the short term over the coming. We believe that we're going to see probably the euro-dollar trading below the parity over the coming month. For people who want to play the dollar versus emerging currencies, we are quite favorable of being long US dollar, short Korean won. Korea is experiencing a political turmoil. They are under pressure due to the weak yen and the weak Chinese yuan that are also not helping the situation in the country. And we think that the negative output gap in Korea is behaving totally inversely than the positive output gap that we are experiencing in the US. And that's probably also a sign why the dollar shall appreciate versus the current one. We think definitely that the sound fundamentals of the US economy, the improvement that we've seen, the reflation trade, and the positive mind of investors going into the new president in the US will definitely help the dollar to go on the current path and might appreciate from the current level probably about 10% over the next 100 days.
Fantastic. Well, thank you so much for telling us what to look out for.
Thank you.
Well, that's all from us here in the Geneva studios, but Dugoscopy TV is regularly updating you with all the latest financial news, so keep clicking back.